Zach says, I'm looking for some advice or maybe some affirmation. Here's my situation. I'm 31 years old. I have a company 401k with a balance of $130,000. This is all in a target date fund, and I do not have the option to move that money into ETFs that we like. I only have the option for other target date funds. My minimum contribution to get maximum match is 10%. So at 10%, my company matches 50%. So I get a free 5%, which is what I'm currently doing. My other account is on public.com, and that's at $24,000. I have $12,000 in a high yield savings account with them, and the other $12,000 spread across SPYI, QQQ, VOO, and VGT. The $24,000 hits my emergency fund target at around 5 to 6 months of expenses. I do not have a Roth IRA or any other accounts besides my checking, which I keep 1.5 to 2 months of expenses in there. I'm currently saving around 5 to 10% a month on top of my 401k, putting my combined savings around 15 to 20% per month. With all that information, my thought was to stop contributing to my 401k and put the current 15 to 20% toward my bridge account and just let the target date fund 401k ride until retirement. My other thought is to leave it at 10%, get some free money, but my gut tells me I'm going to underperform with the target date fund over the next 30 years before retirement. So my analysis paralysis is this. How much would this free money cost me versus putting it all in a bridge account and building that up, knowing I can invest in index funds we all know and love? Really good question, Zach, and I'm going to let Robert kick this one off.
Zach, I love this, and just the fact that you're thinking it through so in-depthly and understanding, the opportunity cost of if you put all this money in the target date fund and it underperforms these ETFs and index funds that we talk about, what is the difference and what does it cost you over 10, 20, or 30 years? The answer is none of us know, but we can assume that let's say the average target date fund earns you 6% a year, but yet VOO or QQQ, let's say they average 10, 11, 12% a year. Well, we know then we have a 5% difference year in and year out over that 10, 20, or 30 years until you reach retirement. So for me, I would always do what Austin talks about. I would get just the match on the 401k, and I would get the rest of the funds into that Roth IRA, into that bridge account. You're only 31 years old, so you have a ton of time to really take advantage of the Roth and then put the rest into this bridge account and do that active management so you can perform really well over the years. And then also the bridge account gives you the flexibility of having money and funds that are available to you anytime you need them. So I definitely think you're on the right track, and that's what I would do. Keep the minimum of whatever the match is with the company, and the rest goes into the Roth and the bridge account, and you will crush it over the next 25, 30 years.
And Robert, just to kind of piggyback on what you said about the Roth IRA, Zach, I mean, you're 31. Let's say you just completely write off 31 years old and you don't start investing in the Roth IRA until 32. Okay. And you start maxing this out by investing $580 something toward it every single month. And then as it also increases over time, you stay maxed out and you continue to invest more and more at this, call it 10 to 12% annual return over the next 30 years, 35 years until 65. You're going to have $2.5 million of tax-free money waiting for you in retirement, all because you started maxing out your Roth IRA. Now, yes, you should absolutely, go up to the match with your 401k. You should get the free money. That's great. Like, go do that. That's fine. We talk about that. We teach that, but don't do it to the expense of maxing out your Roth IRA. We think you have enough in your sort of take-home pay here to max out your Roth IRA. If you don't have enough to max out that Roth IRA, pull back the 401k contributions just a little bit, because we do think the Roth IRA is going to outperform the 401k, considering it's going to be invested properly. It's not going to be holding cash, bonds, international stocks, commodities, everything else that comes with a target date fund. It's going to be invested into American capitalism, right? The S&P 500, the NASDAQ, VGT, VTI, MOAT, all those great index funds and ETFs that we talk about. And those will do 8, 10, 12%. I mean, geez, just year to date, the stock market's up 25% this year, and it was 28% last year. The markets are up 52% since the beginning of 2023. Like, that is just amazing. And so that's what we're trying to get you to be participating in, Zach. And we're not saying it's going to go up 52% over the next 2 years, right? I can't predict the future, and neither can anyone else. But I do know that over a long period of time, it tends to go up double digits, right? Call it 10 to 12%. And by having your money allocated correctly in these tax advantage accounts, you're going to be just fine. So don't worry about the analysis paralysis, Zach. You're crushing it, man, and we're rooting for you every single day.
And I want to add one more thing for everyone to understand. I know we hammer a lot on target date funds, but let's really break it down just for a second. And that is, target date funds are totally fine if you're trying to preserve money because they are built and structured in a way where they're not going to take a lot of risk, so they're not going to have a lot of volatility. And that is totally fine. But what I don't like about target date funds is I feel you leave too much money on the table over too long of a period of time. Now, if you were 51 and you built a decent nest egg and you wanted to have it in target date funds until retirement because you just didn't want to risk going backwards, I'd be okay with that. But at 31 years old, you have a lifetime of high earnings because generally the markets go up and to the right over time. And I just think it's a mistake because you'd be leaving too much money on the table. So keep that in mind. We definitely think you can overcome this analysis paralysis and crush it in the coming years, and we're here to help.